As a non-resident buyer, when you purchase unlisted shares of an Indian company from another non-resident, you have to ensure that you deduct appropriate taxes. Now, what is appropriate taxes? Generally, the practice is that if it's a long-term capital gain, you have to withhold taxes at the rate of 10% of the gains. But due to certain anomalies, generally you should insist to deduct 10% of the gross consideration, unless the seller is able to obtain a certificate from the Indian Income Tax Office that the gain is lower and therefore the tax has to be deducted at a lower rate. In case you are sure that at a later stage, if for any reason the taxes deducted are low and you agree to deduct taxes at a lower rate, you should have appropriate contracts and indemnities to ensure that any liability that falls upon you because you have agreed to deduct taxes at a rate which is less than 10%, you are able to recover it from the seller. The seller, of course, in this case has to be a non-resident. If the seller is a resident, then in that case, the TDS is not required to be deducted.